Hello besties, welcome back to Luna CFE Strategies. If you're new here, welcome to the CFE Study channel. I'm Luna and my passion is to demystify the CFE exam and boost your chances of passing. Tax has long been a headache for many students. You have likely encountered the basics, but there's tons of technical details to remember. For example, the employee versus contractor test. We all know employees lack control over the schedules, while contractors receive a fixed amount but bear the risk of potential loss. However, to achieve an RC or C, only stating these two sentences won't be enough. We must discuss all 6 tests to figure out the employment status, which makes tax a challenging subject to study. Yet, in my opinion, tax difficulty is primarily at the outside. Initially, it's tough to make notes and create a systematic summary of each topic. However, once you have developed a comprehensive understanding of both corporate and personal tax, achieving a C on Day 3 tax becomes easier. So I'm making a completely free Day 3 tax review series where I will help you to build a systematic understanding of Canadian tax and cover commonly tested concepts to ensure your success in a Day 3 CFE. In the first tutorial, I will exclusively focus on personal tax. The slides are linked in the description so you can download and take notes while watching today's video. If you like my content, please subscribe to my channel. To start, I will guide you through the flow of personal tax calculation, outlining the key elements involved in determining tax liability. Later in the video, I will expand on each element. You can use timestamps to navigate directly to the section you need to review. Determining the amount of taxes payable begins with assessing income streams to arrive at net income for tax purpose. The primary income stream people receive is employment income, including salaries, taxable benefits, less eligible deductions. Business income arises from service business, such as income earned from a sole proprietorship. Property stems from owned or used property, such as rent, dividends, and interest. Other income includes, but not limited to, pension benefits, unemployment benefits, spousal or child support. Capital gains realized during the year are also included. Remember that we only pay tax on 50% of capital gains. General deductions not tied to a specific source, like moving expenses or RRSPs, are also factored in, culminating in the net income for tax purpose, or Division B income. Moving forward, we deduct Division C deductions, such as stock options deductions, lifetime capital gains deductions, and applying non-capital loss carryforwards for the current year to calculate the taxable income. During CFE Day 3 tax, calculating taxes payable might not always be necessary, so pay attention to the AO requirement to avoid wasting time providing unnecessary information. Federal tax payable is calculated using progressive tax rates table provided in the examination reference schedule. There is no need to memorize these taxes rates, as they are provided and will be updated annually. Lastly, we subtract tax credits, which is not refundable but reduce taxes payable. Common credits include the basic personal amount, age amount, and tuition credit. If an individual made installments throughout the year, these are also deducted from the tax payable to determine the final tax liability or refunds. Imagine you're a CPA working at Big Four, earning a $60,000 salary. However, due to the high cost of living in downtown Toronto, you have taken up a job as a server at the restaurants in the evenings. This additional work helps you to cover rent and allows you to save for a future down payment. Then the question arises, what constitutes your taxable employment income when you file the tax return? So according to CRA, the income from Big Four salary and wages, tips from the restaurants are all taxable. To add a bit of complexity, CPA Canada often asks students the tax treatment of employee benefits or allowances received. This topic is commonly tested, and apart from performing quantitative calculations, demonstrating an understanding of deductibility from both the employee and employer perspectives is essential to get a C. When a response is being marked, the most crucial aspect is not just calculating the correct figures, it's about your understanding of the concept. Like, how do you determine whether an item is taxable? What criteria you used to guide your decision-making process, and how it differs between employer and employee deductibilities. So I believe we now have a basic understanding of how personal tax is calculated. And let's begin by discussing employment income AOs. These areas are frequently tested, so pay close attention. The taxable automobile benefit is a common AO, involving the calculation of both the standby charge and operating benefit. When dealing with an employer-owned car, the standby charge amounts to 2% of the vehicle cost times the number of months you have access to a vehicle. If the car is primarily used for work, you can apply a reduction percentage to lower the standby charge benefit. For an employer-leased car, the standby charge calculation differs slightly, but similar reduction percentage can be applied if it's primarily used for work purpose. Calculating the operating benefit is more straightforward. Regardless of ownership or leasing, there are just two scenarios. If the vehicle is primarily for work use, you choose the lower two figures. Otherwise, you use the rate of 33 cents per kilometer to calculate the operating benefit. Regarding the deductibility, the benefit is taxable for the employee even if the employer covers an allowance. It remains taxable unless it aligns with a reasonable rate. The employer, however, can deduct CCA or lease payments and monthly interest on their corporate tax return. Calculating CCA for the employer is unnecessary here unless you're working on a corporate tax return AO. Therefore, our response just needs to briefly touch upon deductibilities. When it comes to determining whether gifts and awards are taxable, it boils down to assessing three simple criteria. If all three criteria are met, the gift won't be taxable. Some common taxable items include gift cards, courses for personal interest, or free housing. While you don't have to remember the common ones at this stage, remembering the three criteria is more important, as they help you to identify whether an item is taxable or not. In terms of the tax treatment, employers can deduct expenses, but certain items may still be taxable benefits for the employees. You will see this AO a lot during day 3 practices, so just focus on remembering the three criteria for now. Club dues typically don't stand as a separate AO and are usually part of taxes payable calculation. If the company is the primary beneficiary or if the benefit extends to all employees, it remains non-taxable. However, for the employer to deduct expenses, evidence must be shown to the CRA that these expenses serve the purpose of income generation. Turning to social events. For employees, these events aren't taxable if they're available to all employees and the cost per person remains under $150. Employers can fully deduct expenses for up to 6 events if these events are accessible to all employees. Exercising stock options will create taxable employment income, but you can leverage a stock option deduction under Division C. For public companies, employment income arises upon exercising the stock options. However, Division C deduction is only available if the shares were not in the money at the grant date. Upon selling the shares, capital gains also come into play. Calculating CCPC shares follow a similar pattern. However, employment income is only realized upon the sale of shares, along with the realization of capital gains. The criteria for Division C deduction are relatively more flexible compared to public companies. Holding the shares for more than 2 years or having not-in-the-money stock options at the grant date permits claiming the stock option deduction. It is a common point of confusion, but it's important to note only dividends received by individuals will be grossed up at different rates and claiming a dividend tax credit. Corporate tax returns do not involve this process. For non-CCPCs, taxes are paid at a higher rate. These dividends are considered as eligible dividends and need to be grossed up by 138% of the actual amount. Conversely, CCPC benefits from a lower tax rate through the small business deduction. Therefore, the non-eligible dividends received by individuals are grossed up to 115% of the actual amount. The dividend tax credit amounts to either 15% or 9% of the grossed up amount, depending on the type of dividends. Understanding these calculations is fundamental in determining dividend income in personal tax scenarios. In general, interest expenses are typically considered as capital expenditures and therefore not deductible. However, it's important to know that interest paid on income-generating assets is an exception and is deductible. Remembering this distinction is key when considering the deductibility of interest income. Capital properties are assets where you may incur capital gains or losses upon disposition. However, personal use property (PUP) and listed personal property (LPP) have distinct rules worth remembering. When you sell PUP, it's important to know that a capital loss cannot be claimed. The sale proceeds and adjusted cost base of PUP will be deemed a minimum of $1,000. And in the case of LPP, a capital loss can only offset a capital gain on another listed personal property. When addressing the capital property AO in the CFE, scenarios often involve taxpayers owning multiple properties with estimated fair values in ACB provided. In such cases, advising clients to utilize the principal resident exemption to exempt capital gains become crucial. It's important to highlight that taxpayers can designate only one property as their principal residence per year per family for the purpose of capital gains exemption. The +1 in the formula indicates that one less year can be designated than the total number of years owned while still achieving a 100% exemption. To optimize the exemption, you need to advise clients to allocate the exemption to the residents with the highest gain per year, since this strategy maximizes the use of exemption available. When determining whether the transaction proceeds should be categorized as income or capital, this is a straightforward and easy assessment. Remember to incorporate the case facts and present a balanced discussion of the 4 factors below to achieve C in this AO. When I was studying for Day 3 tax, I used to create flashcards to refresh my memory. While we grasp the concepts, sometimes we overlook the small details in our responses, which caused us to score below RC or C. So, please memorize the formulas and highlight the sentences. Then achieving a C on Day 3 tax will be surprisingly easy. In next week's video, I will continue focused on personal tax AOs, covering moving expenses, RSP, and other common personal tax related AOs. I hope you enjoyed today's video, and I wanted to take a moment to wish each and every one of you the best of luck on your CFE journey. I know it can be tough, but the results will definitely be rewarding. If there's anything specific you would like a refresher on, or any topics you would like me to cover, please feel free to leave your thoughts in the comments below. Thanks for watching, and I will see you in the next video.